I'm Nicole Voelker. I'm a CPA in Peoria, Illinois, and I specialize in valuation. I get a lot of questions, about how the valuation approaches work and why you would choose one over the other, and is there one that's better than the other, or how do you decide which one to use? So I thought I would just put together this little illustration so that, if you're wondering one of those same things, maybe this will kind of help you to see how these approaches, really work in tandem with each other. There's not really one that's better or worse than the others. So let's get into it. So I have just a super simple income statement over here. Revenue less cost of sales gives us a gross profit. Take out operating expenses, that gets us to something called EBITDA, earnings before interest, taxes, depreciation, and amortization. That's going to be kind of a key performance measurement for valuation, so you'll see that referenced a lot. Then I'm just going to take out expected capital expenditures, and that's going to get us to an estimated net cash flow number. Okay, so super simple, but we have this example company here. Okay, so then let's say, okay, that this company, let's say it's a construction company. Okay, so let's say for this construction company, we've decided we're going to do some industry research, and we're going to, see what other similar companies have sold for in this industry, and try to, back into what our company might be worth. Okay, so looking at the market approach, so let's say we've kind of gone through database, looked at different companies, and we've kind of aggregated these multiple values. Okay, so our first multiple here, revenue. A revenue multiple derives value from that top line, 1 million mark here. Okay, so basically what we're saying is that by looking at all these other companies, their revenue was about 35% of what they ended up selling for. So we're going to go ahead and apply that to our revenue, get to 350,000. Okay, now you're gonna pick up pretty quick that we're working in a very perfect world here with this example. So everything's just gonna come out exactly as we would like it to, and everything's just gonna be super easy. Okay, so our next multiple is gross profit. Okay, so that's another performance measure, right? We can kind of see, are we, what do other companies sell for in this same industry? And what we found when we did our research was we found that, companies in this industry sell for about 1 times gross profit. Okay, so let's apply our gross profit. And again, here we are in our perfect world, because we got 350 again. Okay, all right. So we've checked off gross profit off the list. Now let's go to our EBITDA number. Okay, so we've looked at, again, we've gone and looked at all these companies, and we've aggregated the values, and we've come up with a median multiple of 3.5. Okay, so we can kind of assume that our company would sell for 3.5 times EBITDA. Okay, so we're going to take our EBITDA, multiply it by the 3.5, and we're all shocked that we got 350 again. Okay, so our market approach is pulling a pretty consistent number of 350 for this company. Okay, if you have a situation where you apply all these multiples and they're all the same like this, that's a pretty good indication that your company is operating, right there, right in the industry standard, right in the industry averages. Your company's not really more profitable than the industry average. It's not really less profitable. It's just right in there. So that would be something you would expect to see. If your company was a little bit less profitable than an average company within that industry, you would expect to see, these gross profit and EBITDA numbers the indications of value for those to drop a little below the indication of value for the revenue. And then in the reverse of that, right, if your company is more profitable, then you might even see that the indications of value from these might actually exceed the indication of value for your revenue. Okay, so there's our market approach. Now going to an income approach. For income approach, I like to use cash flow, and I like to really kind of focus in on the cash flow, see what is the actual cash being produced by this company, what's the actual impact to a prospective buyer of this company, okay? So if we kind of go from our EBITDA number right here, okay, but then we're gonna take out what we expect to have to spend to keep this thing going, okay? So we're not considering depreciation, right? But we're going to kind of look at this capital expenditures as being, you know, this is the money that we're getting, but we know we're going to have to kind of feed the machine here, okay? So we're going to have to put some back in order to get to a good cash flow number here. Okay, so let's take this 70,000, and we're going to apply that to this 20% capitalization rate. Okay, so I'll just do the calculation over here. So we have the 70,000. Then all we're going to do is we're going to divide by that 20%. Okay, and that's going to get us to, you guessed it, the 350 again. Okay, so it's just another way of coming up with an indication of value. This capitalization rate is going to be based on, a lot of the same things that our multiples are based on. They're going to be based on, what's standard in the industry, what kind of return are different investors in this industry looking for. Also, we didn't consider income tax over here in our illustration, so that would be considered over here as well, right? If you don't feed in the income tax over here in these numbers, you're going to have to fit that into your capitalization rate. So there's a lot of different factors that could make this rate go up or go down. In our case, we're just going to stick with a 20% capitalization rate just for this simple illustration. Okay, so yeah, we can see that the market and the income approach have a very similar way of working, right? We're in both cases, we're looking at economic benefit to a prospective buyer, and we're applying some sort of required rate of return, whether that be by way of a multiple or a capitalization rate. The asset approach is going to be a little different, although we're going to be relying on appraisals done by other experts, equipment appraisers or real estate appraisers that are going to come up with values for the assets that we have within our company, and we're going to just add all those up, add all those tangible asset values up. But the approaches that the property appraisers are going to use to value these tangible assets are going to be the income approach and the market approach. So we're really all using the same techniques here, and everything is really kind of building on those same blocks. So let's say we came up with a $250,000 tangible asset value. Well, we know that over here we came up with 350. We came up with 350 over there. That was for the whole entity. If we came up with 250 in tangible assets, then we could make the assumption that maybe we have 100,000 intangible, which would get us to that same 350. So in other words, maybe we have 100,000 of goodwill in this company, goodwill that's derived from customer relationships, reputation, other things that makes our company be able to generate a higher cash flow than just the tangible assets alone. So we can kind of see how all these approaches kind of rely on each other and work together, and in order to get a holistic view of a company, you really should look at all these approaches to see which one might be the best approach for your company, and possibly one will stand out as being more useful, but in a lot of cases all of them turn out to be a pretty useful exercise to go through. So I hope this was helpful, and of course if you have any questions or anything, feel free to give me a call. I'd be happy to talk more in depth about the project that you might have in mind. Thanks.